Welcome to Corner Class Tampa. I'm your host, David Carmena, and today we're talking about 4 ways to fund your deal. That's right. If you're looking for money to fund your deal, if you need money to fund that deal, you have options for you. We're going to talk about 4 unique ways that you can fund your deal, from traditional funding to non-traditional funding to hard money. We have everything here for you today in this corner class. So, need money to fund your deals? Stay tuned. We're going to discuss 4 ways to fund your deal. See you on the other side. And we're back. And always we start the show with Gilbert Bennett. Gilbert, how you doing?
I'm doing great, David. How are you today?
I'm doing great. I'm doing great. So we made it. We made it, Gilbert. We made it to the other side. We have a new president in the White House. He has his staff going, his Treasury Secretary. He has most of his cabinet in place. When there's a change, there's sometimes, as you mentioned before, the rates may fluctuate. There may be some volatility. What are you seeing out there with the rates?
So what's been most interesting about this is, I think because of where we stood with COVID and the economy, we haven't really seen much movement in rates. Now, what did happen that may have some impact in the near future, right, is the Fed chair, the existing Fed chair resigned, and Biden's appointing new Fed chair who was Fed chair previously, I believe, under Yellen or something like that, and worked in a anti-inflation environment. So what we may see, and what I'm hearing in terms of the industry right now, is no real short-term big moves. Right, the Fed's goal is still to keep the economy moving forward, to not restrict any kind of potential growth we have, because we got to get through this recovery caused by an economic stagnation with COVID. But once that happens, there will be some shift to concern over inflation. They don't want to push us so far, put so much money in the economy that we inflate. We don't want to become Venezuela, where the money's not worth anything, right? So I don't see that in the very short term, but I think as the vaccine distributes, we may see a little bit of an easing of the amount of money the Fed's putting out there by buying things like the treasuries and mortgage-backed securities and keeping the industry rolling. So doesn't mean rates are going to skyrocket. We're seeing other things happen in the mortgage industry right now. Toward the end of the administration, the Trump administration had put out they still wanted to get the privatization or get Fannie and Freddie out of conservatorship, out of that government conservatorship, and push them more towards privatization. Last days of the administration, they set some rules in place, but these were just administration rules. They can change with one administration to the other. But those rules that they put in place for Fannie and Freddie are made to make them more stable, so that they can come out of conservatorship without the concern of them going back. The issue is they may start out with a bunch of rules, but the government and the lobbyists have a big way of easing those rules and requirements on Fannie and Freddie. So the hope is they stabilize them. We do keep kind of this quasi-government-backed entity, because one thing we realized in COVID is if you had, 4,000 banks all creating their own rules for what's going on with mortgages, you would have had a lot of different outcomes. We might have a lot more people evicted right now, a lot more people out of houses. Might have had a much bigger housing impact in terms of housing crash. By the government having a hand and a little bit of control over what Fannie and Freddie and the Federal Housing Finance Authority plus HUD and the VA all following the same playbook, we saw a lot more stability maintained in the housing market. And I think that was very attractive. And that is a case for keeping some kind of government hand over what's happening in the mortgage industry. So those are some of the big things going on. There's a new FHA housing chair, so we may see some easing. I remember the last weeks of Obama's administration, he reduced the cost of the upfront mortgage insurance and was reducing the monthly mortgage insurance. Lenders all set their systems up to do this. And day one of the appointment of Dr. Ben Carson to the FHA, they reversed all that and said, no, we're not doing that. And so the lenders all had to go back and, what the Obama administration had said was, hey, we got enough money stored up in FHA's reserves that we can reduce what we collect from borrowers now. But I think one of the concerns that Dr. Carson had coming in was that, well, last time we reduced it, our reserves got low, and then we had a housing crash and we didn't have any reserves. We went negative and had to beg for money from Congress. So they kept that up. So we may see some lowering of cost or maybe even expansion, hopefully not expansion of guidelines. I'm in the lending industry, but I think FHA is a little bit too flexible as it is right now in terms of borrowers. But hopefully we'll see a little bit of lowering of cost for the borrower when using an FHA loan, make it a little bit better option for them. And maybe we see some reasonable student loan changes or guideline changes as relates to FHA, because they have kind of the steepest and most difficult there. So that's where we are. Haven't seen a huge amount of movement in the mortgage rates over the last 2-3 months. I mean, we've been a little bit down, a little bit up, a little bit down, a little bit up, but basically in the same area. So that's how that has worked. We're probably on VA loans. You're still looking at 30-year loans in the 2.25 range with a decent credit score, 680 credit score. 15-year loans may be available on VA down to 175 if you're interested in those. The conventional rates with great credit scores, if you don't want to pay points and fees, you're probably looking at a 2.875, 2.75 rate range. If you're willing to pay a little bit in points, you can get 2.625, 2.5. And if you want to pay a lot of points, you can even get down to 199 on 30 years. The starting rate on 15-year conventional loans is probably around that 2.5 mark, maybe 2.375 mark without paying points and fees to get it. And those are available as well, all the way down to say 1.75. I've even seen 1.625 on the rate sheets if you want to pay for it. So that's a market mortgage kind of update for you guys. If you have any questions on that, please let the host know, let David know so he can get them out to me. And David, back to you.
All right. So I do want to ask you specifically about this proposed $1.9 trillion stimulus package. Now, we talked before about what you can be used and what cannot be used. The stimulus can be used. We talked about you can pay down debt, but it cannot be used to qualify for a loan. Is that correct?
It is not income per se. It can be used as assets. You can use it as down payment money if you got it, but nobody will consider that as additional income. You can't say, oh, well, I got $1,200 last year, or I have a family of 7 and I got this much money. We're not going to add that to your income or debt to income ratio for qualifying. If you want to use that money for down payment money, that is okay. It can be a part of your down payment. Those are your assets. There's no requirement to repay those assets. You already paid them in your taxes, right? Previous years. So they can be used as assets for qualifying in terms of the assets required to close or the money you need to put down to cover closing costs and down payment. They will not be used as income for qualifying. So we're not going to divide your payment by 12 and give you that amount per month to help offset your debt to income ratio. That will not happen.
All right. So thank you, Gilbert. I'm going to add Roy to the stream. Roy.
Yes.
Introduce yourself. You're a new contributor to Corner Class Tampa. Let's give a little bit of intro. And if you could talk specifically about programs that your institution has as it relates to investors. And then I want to speak a little bit about, from your end, do you see anything that can potentially happen with the stimulus package? Is it better to have a larger one, a smaller one, or does it even matter? Go ahead, Roy.
Thank you. And good afternoon. And I appreciate the invitation to the show. My name is Roy Binger, and I'm a 31-year vet of the banking industry. I've been with banks such as Barnett Bank, for those of you that familiar with that bank that ultimately has become Bank of America. There's a city president for SunTrust here in St. Petersburg area, and worked at community banks as well. I was the president of a community bank in South Florida, and presently I'm at Pilot Bank. I also, have my own independent insurance agency, and from time we have also around 45 different banks that we can do conduit lending through with that institution. So, I'm going to talk today about the traditional end of the bank, and not specifically Pilot Bank, but just in general, how banks approach investment property lending from my lens. And it's important for you to know there are three channels of conventional commercial lending. One, you'll use the term banks. And when I say that, you've got the Bank of Americas, the Truist banks, the BB&Ts, just really big name, big banks, trillion-dollar sizes. And the old saying of, birds together kind of flock together, move together, and their policies, they make the rules for them. Another alternative channel, though, is credit unions. And credit unions are not regulated by the FDIC, they're state chartered, and they have some nuances to how they approach investment lending that may be of interest to you. And the third one is community banks. And these are banks primarily like Pilot that are under $1 billion in size. They're not as heavily regulated as the bigger banks are, and they're more flexible, quite frankly. So let me just tell you, when you're looking at your project, it's good to have dialogue with at least the credit union and the community banks, and you'll get a flavor just talking to one big bank how they're all going to behave. That being said, we usually look for around 25 cents to 20 cents of your equity going into the deal on these commercial properties. Keeping it simple from a pricing perspective, we're going to look at the daily Treasury yield curve. And if you're not a fan of that, I invite you, if you're going to be an investor, go out to the U.S. Department of the Treasury, look at their resource center, and start to track of the daily Treasury yield curve rates, because that is what the banks are going to be looking at to set their pricing. And you'll see that most banks today will want to price their investment property loans typically with a 10-year pricing model going 5 years based off of the Treasury 5-year maturity instrument, and then they'll reset that pricing for another 5 years, and they may add 275 basis points to that. The long and short of it is, assuming that you have a credit score of at least 650, anybody that has a credit score below 650, you're automatically going in as an exception as a guarantor for the loan. So it's critical for you to make sure your credit score passes that mark. If you fall below that mark, you may be into what we call private lenders or hard money lenders, which will be discussed in a few minutes. Take heed. Banks pull a report from a vendor called LexisNexis. It is a lot more detailed. It goes back further into your credit history, and it pulls a lot of detailed information that most borrowers they can't even recall. They're not going for a standard credit score factor from Experian or Equifax or TransUnion. That LexisNexis is a detailed report. So don't be surprised if they pull things up and ask you about what happened, in 1950 something, just crazy. But that is a report and does give you a more factual credit rating. The last thing I want to just touch on with that is that anything you look at, you need to be able to have a debt coverage ratio of 1.2. And I hate using terminologies like this over a call like this, but usually for every dollar of income that the property throws off after your expenses, core expenses, the bank expects for you to have a $1.20 to pay for the debt, or $1.25. And most of our investors are looking at a cap rate in the range of 4 to 6% range. So I'm going to stop there. I know I've just threw a lot of information out to you, but that it's very important for the investor to know at least that high level information.
All right, so yeah, you hit us with a lot of stuff, and so I want to make sure that for the new investor, I'm going to bring Gilbert back on the stream too. I want to make sure that for the new investor, they kind of understand what they're doing, and once you graduate to a level of being bankable, then you not only are you more comfortable or more knowledgeable about the terms and what makes you more bankable, but in fact, let me do this. I'm going to add Rick before we talk about bankability in for a particular project. Rick, you're being a hard money lender, and that's why we have you on the show, is that your criteria for the individual as opposed to the project is a little bit different, right?
Yes.
So let's talk about your criteria about a particular project. And let's say that, I'll give you a scenario. They have a house that they found in the Tampa Bay area. And let's say that the property is has some upside. They can buy it for 120, 20K, 30K in repairs. And and 30K in repairs, and then they can sell it for, let's say, 220. So that's the project they present to you. What does your organization would do with that and that individual at a time, with respect to the project and with respect to that individual's bankability?
Yes. So basically with that type of situation, that's kind of like our bread and butter. We're mainly looking at the value of the property. So as far as like the deal is concerned, we would require an appraisal to kind of determine the as-is value as well as the after repair value. And basically, as long as it makes sense, where it looks like you're going to make a profit in trying to either do a flip or do like a buy and hold, that's something we can definitely fund. Now, as far as like how we qualify an individual, we have just minor guidelines as far as what we can do. The main one being, as far as credit is concerned, our minimum is 660. And then we price you based on your experience. And by experience, I mean how many rentals you own or how many flips you've done in the last 36 months, and basically how many you successfully like bought, flipped, and successfully like sold. And then rentals, how long have you managed them? At least we have a seasoning of at least 12 months to count that as a rental experience. And then we have a tier system, and the higher up you are on that tier, the better pricing we can give you. And by better pricing, I mean obviously lower rate as well as a higher loan to value on what we can finance on the purchase. So if you're like a first timer looking to maybe flip like your first house, and just that first deal is the numbers as you suggested, we can actually do that. You'd probably be eligible for around 80% loan to value on the purchase. And then as well as like the rates, that would make sure as long as you qualify where you're above the 660 in that lower tier, you're probably looking in like, I'd say around like the 10-11% range. And then as well as the actual deal itself, you would pay for an appraisal that would come back. And as long as the values hold true that show that there's a profit there, then we would proceed on doing the deal. We're not going to ask for any of your income docs, so we don't really care about like your tax income or your any paychecks or anything like that. The main thing is that you have the funds to actually close on the deal, and then also that the appraisal basically supports that the deal makes sense.
So other than the 660 minimum credit score, really it's all about the deal, right?
Correct. There is another caveat I think I mentioned also with you on another deal is that basically we do require we don't say require is the right word, but we do ask that they have at least 12 months of mortgage experience at any point in the history of you. If you don't have that, I can still do the deal. However, just the pricing is a little less. I have to drop the LTV slightly by 5%, as well as I have a cap on my after repair value, which is the max loan amount that I can normally do is 75% of whatever the after repair value comes back as, but I have to drop that to 70 if you don't have any 12 months of mortgage history at all. So again, we could still do the deal, but again, the pricing is just a little harder, so you'd have to bring more cash to close.
Yeah. So for the Dave Ramsey type, you know, and I'm one of it. I've been a cash guy all my life. You know, and never had a mortgage. I actually paid cash for all my properties. You know, that is something that you need to think about. But in general, would you say that, and I'm gonna bring you in this in Gilbert and Roy, that you know, while the rates are not compatible with you know, what Gilbert or Roy can do, you know, it's one of these, a flip deal is something that you should have a lot of skin on the bone. So your cost of money is just another element to the deal, you know. And so if you have a spread of $60,000 and it costs you $3,000, $4,000 to do the deal, you're still making money on the other end. But gradually, you want to mix that or be able to graduate to different tiers of money, and your money will cost you less to do the deal. Rick, what is the maximum amount that your organization, Templeview, can do on a particular project?
So we go up to, our caps are basically a minimum of 75,000 up to 2 million. If you're in my lower tier of experience, the max loan we'll do is 650. If it ends up being over that, we can get an exception on that. However, the deal's got to be kind of like a slam dunk, you know, an insane amount of equity, you know, you're getting from it. But for the most part, we allow up to 5 million in total of like actual loans. So if you have somebody that wants to do like, you know, 5 loans or something like that, we're not going to prohibit that as long as you basically don't exceed that 5 million cap. And then we usually, even at that point, if you ended up exceeding it, if you've paid off like a couple loans with us, we'll probably approve it and move forward on that. But for a first timer or somebody that hasn't done too many of these, usually the max loan amount that we're going to allow up front would be no more than 650. And it's obviously going to be highly based on that appraisal with the values making sense. And then to kind of protect us on our end, as well as also helps the client out, is we finance the payments into our loan. That way the client doesn't actually have to make a physical payment. Most of our loans are 12 months. So in your case, the numbers you gave me earlier, where like somebody was doing a rehab project of 30K, chances are they're probably going to be done in like maybe a few months, 3 to 6 months, I would say. So should they finish sooner than that, not only are they not having to make a payment, but we'll also refund the payments back that they didn't have to use once they're done. This kind of gives us security knowing that, you know, the loan won't default, as well as it also allows the client to not have to worry about making a monthly payment and just focus on the project.
Now, Gilbert, we talked about, again, we're looking at 4 different ways to fund your deal. Rick, hard money is one way to fund the deal. What are some other ways that you can fund a new investor can fund a deal? I'm thinking about maybe home equity lines of credit or something like that. What are your thoughts on those?
Well, I talk about some other traditional, and I know we had Roy talking about some bank options in there. So I'll talk about a few different ways. So now, if we're looking for buy and hold, you have a lot of options. My original home that I still own, fourplex, I've mentioned this on the show before, I purchased with FHA financing, 3.5% down on a 4-unit building with rehab funds. I still own it today. I actually just refinanced it, and I pulled another $150,000 out of it. be honest with you, I didn't even pay $150,000 for it when I bought it. I paid $120 for it when I bought it. So that deal, if you look at the way Robert Kiyosaki talks about getting your money out, that deal, that property pays its own mortgage, pays its own taxes, pays its own insurance, and has netted me money monthly since I purchased it. So FHA, VA financing both allow you to get into 4-unit buildings. For VA, 0 down, FHA, 3.5% down. And they both allow you to qualify with projected rental payments from those properties. So that's one just traditional way using the standard for financing that you can get into an investment property, in particular if you don't have a lot of experience and don't want to take on maybe a high interest or high interest debt, or don't have a lot of down payment money, but you have done something by either providing service to your country and eligible for a VA loan, or by coming up with that 3.5% down and qualifying for an FHA loan. All right. Another option in terms of financing a deal using very traditional methods, Fannie Mae and Freddie Mac. For those long-term holds, Fannie Mae and Freddie Mac provide both purchase and renovation financing for investment properties. Now, you're looking to finance a single-family home, you probably need at least a 20% down payment. The 15% is an option. Rates are horrible, very hard to get the loans approved because people don't want to do mortgage insurance on them. But 20 or 25% down payment on those deals will get you into a buy and hold long-term using Fannie or Freddie financing. So you can finance the property. And again, even then, you can use projected rental payments from that property as part of your qualifying income. The appraiser has to say, this is what we project the rent to be on this property. And the underwriter will take 75% of that projected rent into account for qualifying you to buy that home. So it's very possible for you to get into a home with the projected rental payments that way. All right. Another method whereby you can get money for investing, property flips, or buy and holds that we've helped people with. I recently had a client refinance his home. I've had multiple clients in 2020 refinance their home to put a 30-year fixed rate loan at a very low interest rate and not have to come out of pocket to do it on the existing home they have, so they could get cash to purchase investment property. So you can use the equity in your own property that you own right now as a method of getting cash. The reason they elected to go with a 30-year fixed rate loan versus a line of credit, equity line of credit, or home equity loan through a banking institution was because they were getting a 30-year fixed rate product that didn't fluctuate and gave them a stable payment they understood from the beginning. Usually you can get on a Fannie or Freddie refi, you can go up to 80% of the appraised value of your house. You get better pricing if you stay below 75% appraised value, but those rates are still under 3%, and it's 30-year fixed rate financing, and it's still under 2.5% on 15-year financing. So it's a good option if you have equity in the home you live in. Another option is to walk into a bank or lending institution and say, hey, I want to get a home equity loan, home equity line of credit, and use the equity in my house through that method. That method is going to have lower closing costs. That method, because of most banks are going to pay a certain portion or all of the closing costs on that home equity loan, with the stipulation that you have to keep the loan open for a certain amount of time and you have to actually draw down a certain amount of that money up front. But those are good options for borrowing from banks. Now, we do have, I would say, non-necessarily hard money options for buy and hold properties, and these are long-term rental properties. We have debt service coverage ratio. Now, you heard the DSCR Roy talk about debt service coverage, and he explained it very well. For every dollar you have to pay out to maintain that property, lenders are going to expect $1.10, $1.15, $1.20 coming back. And as long as that's the case and your down payment is sufficient, those start at 20% down payment, then you can qualify to buy a property regardless of what your personal income is. We don't care about your personal debts, personal income. We qualify the property based on the projected rental income. These methods are buy and hold, except for the home equity line of credit, which could give you a revolving line whereby you can use that to flip properties. Those are kind of some of the traditional ways you can go about getting funds or getting funded for buy and hold properties. The equity line would be an option for buy and flip properties. Also, pulling the home equity out of your home and then having it available in cash to be able to make a competitive offer or go to a sheriff's auction or making a cash offer to a overrun home you see that may not be on the market. That's an option to get that money and put it in the bank, and then you just circulate that money yourself. But I don't know if we have anybody talking about it. I'll tell you how I bought my first house here in Florida. I borrowed from my 401k. And actually, I don't know if anybody's going to bring that up, but that is what I did.
Yeah, and actually talk about that. We're going to include that in another show, but briefly, go ahead and talk about, you know, borrowing from your 401k, self-directed 401k, those type of things. Go ahead, brief.
Well, so caveat, I am not a financial advisor, certified financial planner. I will tell you what I experienced in doing so, and you can glean what information you can from that, but I am not providing you any financial advice. Absolutely. As far as that. All right. But when I got to Florida, I wanted to,
entertainment purposes only.
Yeah. I wanted to purchase a property that I could put on a vacation rental site or something like that. So I saw an opportunity and I borrowed $50,000, which when you're borrowing from your 401k, I believe that is the limit, the $50,000 limit. You can generally borrow from your 401k. What I found out was I could get $50,000. If I was buying a primary residence, I could have 15 years to pay it back to my 401k. If I was getting a investment property or non-primary, second home, non-primary, I could have 5 years to pay it back. So I borrowed $50,000 from my 401k, and I bought for cash a little home over in Clearwater, 800 square foot home that I believe to this day has paid me about $22,000 in gross income per year since buying it. And I've probably made the money I borrowed plus all my costs back about 3 times since purchasing that property. But what I did was I borrowed from my 401k, it paid cash for the property, added some rehab money in there, and then got it up on the market in terms of renting it as a vacation rental. So that's one option. Another option is using a self-directed IRA or 401k. That requires you to hire some kind of administrator to do the paperwork, and they charge you money for that paperwork. But you can direct the money and keep it separate, where you could actually put money into an IRA or 401k and grow that money basically in that 401k or IRA by directing it to purchase properties for you, whether they be income producing properties where the income goes back into the 401k, right, as investment income, or as buy and flips, where you just flip it and you just turn it over and turn it over and turn it over and make money. So that is another option that you would have. That's, I guess you could say, a little bit outside the traditional, but that's it. I got to run, guys. Any other questions, David, before I pop off and hit the rotary?
Yeah, let me check to see if anybody. No, Gilbert, we're good. And we're going to have you back as a someone who actually have done that using your self-directed or the 401k to fund. I'm gonna have Ty, he is a certified financial planner, back on the show, and we're gonna talk about a second level of assets that a lot of people don't think about, that they have, that they can use to leverage against for investment properties. You know, there's insurance in certain types of insurance that you can use, 401ks. There are other lines of credit, business lines of credit. So we're gonna have another show that's dedicated to that type of method that can be used to fund buy and hold property or even flip properties. Okay, but thank you, Gilbert. Thank you so much. You always are a friend of the show and always bring a lot of knowledge and experience. I really appreciate it. Enjoy your Rotary meeting.
All right, y'all have a great day.
Roy, I'm gonna bring you back. Okay, so we talked about first the kind of a hard money way that can be used to, and Rick has a product that can be used for flips as well as buy and hold situations. Usually those products are shorter in duration. And then Gilbert came in and discussed, more in my mind, once you become bankable, that is kind of the second tier. But really, when I think about community banks and I think about the big banks, I'm thinking about larger jobs, right? I'm thinking about, jobs that are million plus, 800, 900,000 to multi-million dollar projects, multi-year projects. And while this show is really geared toward young investors, new investors, flippers, and some buy and hold, there are situations that you may run into where you're doing a small development or you're doing, a larger multi-year product, something that's over the $2 million limit that is in Rick's sweet spot, and something that's outside of, you need more funds than something that your equity that you have in your home or something like that. So does Pilot Bank have any programs for a more seasoned investor, or are there some deals that you're kind of looking at that you can speak to?
I can. I want to first just touch on two quick points, if you allow me. The being a first-time investor and running through some of these programs that we're talking about is absolutely it's fantastic. What I see typically that has not been discussed yet is another venue that I think you can take as a young investor, and it's really boils down to, because I get young investors, but typically they have a mentor with them, and a real seasoned 25-year vet, good financial numbers, and just kind of showing you the ropes. And they may even form an LLC with you and do one or two deals with the bank, and that allows the bank to get comfortable with you and in essence make you more bankable, establish a line of credit so you can do these deals at lower capital costs, and it's like a developer line, or we call them guidance lines. So I know that wasn't discussed, but it absolutely is the best way to get into a good bank or credit union, because you have investors out there selling and buying, and every now and then something clicks. Team up with somebody and do one or two deals with their bank, and they get to know you, and then you're in. Does that make sense, David?
Yeah, absolutely. And so joint ventures, partnering, that type of thing. We've actually talked about that, and actually, to be fully transparent, you and I have talked about that on a particular deal. And we try to be as transparent in this show as possible, and we actually practice what we preach. I'm going to actually, and I'm going to take a minute and bring everyone in.
Sure. And then, David, just one other thing, David, if you can, the banks, when you look at a transaction at the bank, regardless of size, we're going to do a litmus test to your liquidity. You should have around 10% of what you're going to be borrowing in cash. That's one of those weird little quirks that nobody tells you about. But if you're going to borrow $1 million, you better have 100 in liquidity, or you can scale that down to your size. But I see a lot of times new people coming in, they want to borrow the money to do the flip or do the deal, but they just don't have any cash reserve to fall back on, and the deal usually falls for that reason. But they don't tell you, they don't say You're not strong enough. They just look at your liquidity and say it's not there.
And so actually, dude, that money also, and that's so true that, and I'm glad that you mentioned it, because that is the little known secret. And that money has to season a little bit in the bank. At least I was told it has to be in the account for, a seasoning period. Is that correct or no?
Yeah, they ask for in final underwriting proof of liquidity. The minimum will go 3 months, but they want that money in there for over 12 months.
Mm-hmm.
And but the other thing, David, is when you're talking to a bank versus what Gilbert and was talking about, the loans that we're doing, we're keeping. We're not selling those to Fannie Mae, Freddie Mac. There's not a secondary market for these loans. The bank's actually keeping them on their books. The only thing they'll sell is like SBA loans, and so that's why you have the different criteria. It is a cheaper source of capital. I know we're not talking about swaps and things like that on this show, but ultimately, once you're in the bank, you have a line of credit for your building, fix and flips. It's just a lot easier, and customers like it. They get to see what the project is, and they just get bigger and bigger and bigger.
Right. And so we're going to bring you back on. We're going to have more of an advanced show where we're really talking and digging a little deeper about how to finance, how to, the real requirements that a bank is looking at, those type of things that are for people that are a little bit stronger. The JVs, syndications, the partnering, all those things that are a little bit more advanced for becoming bankable to a more traditional bank. Because as you mentioned, the larger projects, you need larger money. You need to be a little bit stronger. You need to have a little bit more liquidity in your bank. You got to look good, and that may mean partnering with a stronger guy for the first couple of deals, right?
Yep.
Now, back to opportunities or programs that your maybe the community bank, and Pilot is a community bank.
Yes.
And so I know that you guys have a sweet spot. Let's talk about your sweet spot. But then also you mentioned a term that about a guidance fund. I think you said
A guidance line.
Guidance line. Let's talk about that. That's a new one. I haven't heard that term before.
So David comes to me and with our first deal, and it's a fix and flip or fix and hold. So typically the 25% is the purchase price, and then he'll present to me a CapEx or capital expenditure budget to rehab the facility. And he has to put down at least 15 cents of every dollar I'm going to lend him on the capital expenditure, the rehab piece. So we'll do a 6 month to a year interest reserve, so prime plus 1 or 1.5% until you build and stabilize property, and then we go into the your P&I. Then that works well, and you bring me another deal very similar to that, a little bit bigger, and I start to underwrite that with you, and then you're looking at another deal. Well, I won't tell you that what your capacity is with me, but in my mind, I'm going to pre-approve you for like a $1 million line of credit, but you won't know the number. That's called a guidance line. But as long as you bring me a deal that looks like the other two, I'm going to fund it up to that cap. That's a guidance line.
Okay. So, and they're not going to tell you that number necessarily.
No, because they don't want a commitment. But you will say, "Hey, Roy, I just saw a deal out in Melbourne. I want to buy it. I need a term sheet." Great. How much is it? It's 200,000. Okay. I've already done 2 or 3 for you underneath that number. I can give you that term sheet tomorrow. Tonight, within an hour. Does that make sense?
Right.
So I don't need a lot.
Mm-hmm.
It's kind of, it's on the residential side, you have to have a pre-approval letter.
Right.
On the commercial bank side, I mean, Rick can probably move a lot faster, but commercial bank side or community bank side, it may take you a week or so to have some pre-underwriting before they give you a term sheet. With the guidance line piece, it's like an hour. Here it is. But I know I'm going to do it for you.
Mm-hmm. What's similar though is that it's about relationships. So Rick, you mentioned that as you become more comfortable with the person you're working with, it becomes a lot more easy on your end and a lot more easier on that person's end, right?
Correct. Yeah. The main thing is paying off a loan. So, I mean, once you pay off like one or two, it's pretty much, and we've got most of your docs from the first deal anyways. It's pretty much, we're just ordering an appraisal and waiting for that. And if everything matches up there, it's smooth underwriting, and we can clear to close and pretty much wrap it up quickly. I can get you a term sheet, proof of funds, literally same day, especially for a repeat client. No problem at all for the most part.
All right. So again, I want to take a few minutes about, some of the things that both Rick and Roy talked about. And again, we try to be a little bit transparent. I personally, if you become a member of Corner Class Tampa private Facebook group, you'll see what we're talking about. But I am personally purchasing a flip that I am using Rick's funding potentially, because Rick, did you approve me yet, Rick? Am I approved yet?
I'm waiting for the appraisal.
I have the money.
Waiting for the appraisal.
But we're using Rick's money. And remember, I always say other people money. Well, Rick is other people money, and we're using his money for a deal that would potentially we can flip really quick and make a decent return on. And so we're going through the process. The process that Rick outlined is exactly the process we're going through. And we're using that money real time to purchase a property. Hopefully, I think on the 10th, is it somewhere around in there, between the 10th and 12th of this month, we're going to be closing on it.
Yep.
And then we're going to rehab it and sell that property for a profit. And again, if you become a member of Corner Class Tampa Facebook group, we'll show you that project. The project is called 83rd Street Project, and we'll show you that project. We'll show you the step through. And in it, as a additional offering, is that in March, we're going to have a show that dedicates to your first flip. And so we're going to talk about putting all these pieces together. You got the property acquisition, you have the money, you have the rehab team, you have all these things that are necessary to have a successful flip. Well, we're going to cover all those things for you, but we're using for my flip, we're using Rick's money to purchase that, and potentially, because I'm Ricky, I'm not going to hold you to a commitment. There's a couple other things that we got to go through, but we're using that money. And having said that, we're working on larger projects. And so I actually called up. I've known Roy for 3 years now, Roy? A bunch of years, right?
Yep.
But we never did business together. And so we talked about some things that we was going to potentially do. But I called him. And Roy, congratulations on your position.
Thank you.
With Poly Bank. Congratulations. Actually, I met Rita yesterday. Rita Lohman, who is the owner of Poly Bank. We was at one of the private clubs I go to, and very nice lady. And so congratulations. But anyway, when Roy became, now you're VP of a certain of this territory, right?
Yeah.
What exactly is your position?
So I'm Senior Vice President Market Exec for Pinellas County, but we can do loans anywhere in the state of Florida. All
right. So I called you up and I said, hey, I have we want to build developments, and I need $5 million, then something like that, right?
Yes.
And what's nice about it is it's nice that you didn't hang up the phone in my face. I appreciate that. But then also, we talked about ways of making that happen and what we need to become bankable. So really it's, and I mentioned this before, when you don't have money, you're looking for money. for a deal. When you have a little money for a deal, you're looking for more money for a deal. And then when you have more money for a deal, you're looking for that money to be cheaper. You know, it's a constant look, you know, because the more liquidity, the more assets, the more money that you have, the more opportunities that you have. And it's all about relationship. Is that a fair statement, Roy?
It is, and I think these times that we're in, it's unprecedented to have rates this low for this long.
Right.
And they are going to go back or bounce back. So,
right.
You know, if you're thinking about doing it, you're not going to have the same thought process come next January or February when rates have doubled. You know, and it's harder to even get financing then. So for those that are stepping in now and taking advantage of these low rates and building their resume, I highly encourage you to do that, because in probably less than a year or so, it may be a different harder market.
Yeah, you guys are going to still be there in a year or so, but the numbers are going to be different. You know, your cost of money may be different. So it's better to establish those relationships and now take advantage of what's happening now, because in a couple of years, guess what? You guys are going to still be there. The relationship's going to be established. The best deal possible, probably you guys would be able to present to an investor, but then also a level of comfort is there. You know, you've done deals before. You know, I can go back to Rick and say, Rick, you know, we've done 4, 5, 6, 20 deals over the last couple of years. Rick is going to try to give me the best rates he has available. Right, Rick?
Yep.
Roy, I've done $5 million with you on a successful project. Now I want $10 million to do a project. Your comfort level will be a lot, you know, easier, a lot more comfortable with saying yes to something like that than if I were to say, hey, Roy, give me $10 million and you don't know me. Is that correct? Is that fair?
That is absolutely fair, and the cost of capital is still is relatively cheap for your project through the bank.
Mm-hmm. So I want to thank you guys for coming to the show. I'm going to do a little recap after the break, but is there anything that you want to add before we go?
You know, I didn't touch on this before, but organization plays a key role in these deals. I mean, having a good bookkeeping process, being able to do a basic pro forma, and keep it simple, but, you know, put a package together that makes sense. Quick little bio, resume, projects you may have done before, and organization of what your returns were. It just makes the whole process easier for the bank and the lender, quite frankly, to make a decision.
And I'm curious, does that package go to the underwriting also, or does it stop at your desk?
It goes to the underwriting. Everything we do goes into a shared drive, and the underwriter can see it. Emails that you send, we do at least I do, but you know, they file print screen into an Adobe PDF, put it into the file, so all the communications are there, and these things get audited. So, you know, when you're talking to your banker, there is no don't tell anybody kind of conversations. They're documenting it.
Mm-hmm. Wow. Yeah. But so the sunshine law doesn't apply to you. It's just good practice, is what you're saying, right?
Yeah, correct. You know, you want to make sure that you're extremely consistent, because at least on the bank side, I don't know about Rick's side, you know, your file could be audited and looked at by a federal agent. Just, you know, luck of the draw. And that's why a lot of customers didn't even want to do the PPP loan, even though that was, you know, almost free money. I had a lot of customers like, I just don't want to run the risk of Uncle Sam looking.
Mm-hmm. Mm-hmm. Yeah. So that is good. That's good information to know. The having a good little package and stuff, and then also that adds to relationship.
It does.
While we're talking about relationship, Rick, you guys, the underwriter is not an independent person. You guys actually know the underwriter. And Roy, the pilot bank decision making is local, so that's another advantage of having a community bank or a credit union, is that in most cases the decision makers are local. The person who can say yes to the loan is local, and you may have a relationship with that person, right?
One or two level up. It's as simple as me maybe calling Leader or our CEO Roy, or saying to Roy, hey, I want you to come out and meet David. He's looking at a project, and he'll come out. When you're going to a bigger bank, it's just the decision may be made in Atlanta, it may be made in Kentucky. They don't know the market as well, and they can say no, and there's no repercussion.
And Rick, your people, your underwriters, your ultimate decision makers, that's right in your office, right? Or you touch and feel these guys every day.
Correct. Yeah, I probably message my underwriter, just casual conversation all the time, just to stay in their good graces. But that way, if a certain situation comes up where I maybe need to explain, like, hey, I'm submitting this file, but you're going to see something. This is what's going on with that. Every deal that I submit, I have to do a loan submission report, which kind of gives them a summary, a breakdown, pretty much the story of what's going on with this. The pros, the cons, just the whole thing. And so normally, if it wasn't for COVID, most of them would be in the office right now, but a lot of them working remote. But we still have like inner conversations in our own personal chats. But ultimately, if I need to describe something with them, I can always go to them directly. And then I also have my upper management who needs to approve any final exception related things. They're also in the office, so I can always just walk down the hallway and try to get at least an answer for the most part, same day.
All right, awesome. So, Rick, do you have any last words, or again, we talked about some intermediate level funding, and then we talked about advanced, but primarily for this show, we're looking at the new first time investor. They've done no deals or a couple of deals, and they're looking for money to fund a typical flip.
Mm-hmm. Yep. Pretty much as I mentioned earlier, we can definitely do it. Our pricing obviously would be a little different than someone that's experienced, but again, it's something that we can do. So I think Roy mentioned earlier, where a lot of them are looking for a certain percentage in your account to even consider moving forward, so they know you have the liquidity. I'm mostly just going to give you the terms and show you this is what your cash to close is looking to be. Since we finance the payments, I'm not really going to care about you being able to cover that, because we're just going to finance it into that. So as long as you have the cash to close, and you can do it, then we'll proceed. Obviously, what I would recommend doing, just because I'm not really in the business of having just a one pop guy come in here and do his first deal and fail just so we could end up foreclosing it. That doesn't really make me money long term. I want someone to succeed. So usually I do my own research on when you send me a property. I kind of look it up, see what comps are you looking at that supports the ARV that you think you're going to have, so that way you can have a successful flip. Because if you're going to, honestly, I've seen a lot of deals where first timers, they'll see oh, this is a great deal. I'm buying this for 100. I'm putting 25K in it, but the ARV is going to be 150. I'm going to make a killing on that. But then I'm well, you're not factoring. Are you factoring closing costs? The payments. If you're assuming you're there for a certain period of time, plus when you're ready to sell it, you got to pay closing costs again. So after that, you might end up with $5,000-$7,000 or something like that. Is that something you really want to go all in on that risk? Especially if your own money, if you've only got let's say the cash to close was 15 grand and you've only got 20 to 25 in your account. Do you really want to risk all that just to maybe make 5 or 7 grand? So I'll discuss that with you and let you know, hey, if you're not holding on to this property and actually trying to flip it, it's really borderline, not really much making profit here. So, while we technically could approve it, I would probably, reassess maybe either what your budget is, maybe talk to your contractor. I think we've mentioned in previous classes, it's very important to have a good team. So that way, you have a clear assessment of, what the costs are going to be. Because a lot of times if you're getting a new contractor, they'll tell you one thing. And then when you start a project, they might tell you another thing. So it's good to have that team built up front, so you have a trust and, not too many surprises come in there. But most of the part, I'll let you know up front too, to be hey, this is what it looks like. This is what it could be. So that way you can assess if that's something you want to move forward with. Because at the end of the day, I care about the experienced guys, and the only way to become experienced is by doing multiple deals. So I've had guys that have started at my lower tiers doing their first or second deal, and they're now doing like their 8th or 10th deal, and their pricing's like even better, and it's just smooth sailing. Like I have like a brief conversation with them at the beginning when they send me the deal now, and it's just a matter of, here's the app, all right, I order the appraisal, they pay for it, and then I'm like, all right, cool, I'll check back in a week. I already have most of your docs. Just get me this one thing that I need. And then when the appraisal comes back, I check back and say, hey, all right, got the appraisal, numbers look good. Submitting to underwriting. I'll let you know any final conditions. And then that's it. My conversations are pretty brief with them now because they already know our process. We already trust them because they've done loans with us. So it just, but of course, like anything, you need a foundation. So the first building block on that first deal, I'm definitely, particularly for a first timer or a second house, I'm going to look at that and look at comps myself, because also I don't want to waste my own time and do a deal. And then if I find out that the ARV you think it's going to be, I look it up and I say, I don't see any properties that are selling for that. You're asking for a 3-bedroom, 2-bath, and they're all selling for like 120, and you're thinking you're going to get 150. Why? So I'll always come back and question that just to see, if that supports it. So we don't waste your money on you trying to pay for an appraisal, you trying to commit a down payment to a seller, and then just to find out that the values aren't even there. And, we wasted time trying to ask you to gather docs and spend money, and just so that we can't do it because it doesn't make sense. So that's definitely something I would consider, especially when you're doing your first deal. But of course, I'm aware of that myself. So are we, and we're more than happy to obviously look into it, especially on a first timers deal, to make sure everything makes sense.
All right. So that is awesome. That is awesome. Hey, listen, I want to thank you guys for coming to the show. The information that you are presenting to our audience is awesome. We did go a little bit more advanced. We're going to probably bring you back, Roy, to talk about, at a more advanced level, to talk about, more about the insider secrets from banking and becoming bankable to the community banks, the credit union, and then ultimately to the big banks. But you got to start somewhere, Rick, like you said. And then no matter where you start, it's all about the relationship. You're developing a relationship with that person. Because even if they have a relationship with Pilot Bank, there may be something that they still want to do with Rick, a little quick hitter. And so, again, thank you guys for coming. I really, really appreciate it. We really, I think that the show was awesome, and I think that we answered the 4 questions, the 4 ways where you can get traditional funding. So after the break, I'm going to kind of do a recap. We want to talk about a couple other things, and then we want to talk about that partnership. Roy mentioned about the need to partner, and even Rick mentioned about the need to partner with somebody, someone who has more skill. Let's talk about that a little bit more on the other side of the break. All right, welcome back. So there are times where you're going to need to partner with someone. That's a fact. Whether it's a small flip or it's a larger deal. Most investors, if they're smart, will try to have a mentor or partner with someone that's done it before, or someone that's actually doing it, preferably. A lot of these mentors, they've done it back in the day. And while they offer a lot of experience, things may have changed, since they developed something or flipped something 10 years ago. Well, things have changed. The basics are still there, but access to money, maybe there's different codes, different setbacks for sure, possibly in certain areas that wasn't there. Homes are not being grandfathered in as much as they normally are. So there are a value add to someone who's actually doing it. I'm going to add a text here. Let me remove this, and I'm going to show you a way that you can partner with us. If you just were to type partner at 833-693-0019, if you're stuck, if you have a deal and you're stuck and you just need someone to help you out, you need a partner that can, it could be anything from advice to actually partnering with the deal. I want to give you an option to do that. So if you were to text this partner at 833-693-0019, if we can help you in any way, that's what we're here for. We're a community together, and I'm passionate about helping people learn how to play the real estate game. Here you go. Okay, hopefully you've gotten that. And if you have a deal that you're stuck, if you are, it's not a formal relationship, you just, hey, listen, I have a deal. I do want to assign the deal to you, or I just want to get rid of the deal. I have a deal, or if you have someone that is a good fit for this deal, we have an opportunity. We have a extensive investor list, and so I want you to have options. I don't want you to get into something where you're over your head. You're losing. Most cases, you're putting down, 10 to 25 to 35% if you're not experienced equity on this particular deal. I'm sorry, down payment on this particular deal. And so you stand to lose a significant amount if you can't sell the deal, if you do not have an exit strategy. I don't want that to happen. So here's an opportunity where if you have a deal and you want to offload that deal, here you go. You can send that deal to us, just text it. We could, and we'll try to match make you with you to someone who is interested in doing that deal. And a lot of you guys, if you mentioned, if you was at the wholesaling class last first Wednesday of the month, we talked about wholesaling where you're not using your money at all. So you really need to be able to offload. You really need to be able to sell that deal or assign that deal to an investor. So here you go. Here is the information you need if you have a deal and you want to assign it, or if you need advice on a particular deal. Here you are. And lastly, if you like content like this, if you want to see more content like this, I want you to like all of our pages that's associated with Corner Class Tampa. So we have a Facebook page, we have a YouTube channel, and Instagram. If you are interested in more content like this, please, in the chat section, please feel free to do a comment. If there's something that we can answer, we definitely will. We are now doing a recap show on the second Wednesday and fourth Wednesday of the month. So the first and third Wednesday of every month, we're doing a new show, a new topic, and then we recap, doing a recap show the second and fourth Wednesday, where we answer questions. Same place, 11:30 a.m., and where we answer your questions. Because like in this show, we had a lot of terms that a new investor may not be aware of. We talked about debt to income ratio. We talked about debt only loans and a lot of other things. The golden rule, 1.2% return, that type of stuff. We want to break that down into bite-sized pieces where we explain that in more detail and answer your question. So that is happening in every recap show. So the next recap show for this, show will be next Wednesday at 11:30, where we talk about the 4 ways that you can fund your deal and answer your question. Now, in this particular segment, the 4 ways to fund your deal. We talked about many ways where you can, but hard money, that's one way. We talked about the FHA, the 401ks. We talked about FHA and VA. We talked about Gilbert discussed the rehab loan that he used to purchase his first home. That the FHA rehab, another way to fund the deal. We discussed using your self-directed RA or 401k, another way you can fund your deal. HELOC, another way to fund that deal. Home equity line of credit, another way to fund that deal. Doing the refi on your particular property and pulling out equity from that property. That's another way to fund your deal. So that's just by itself are 6 ways to fund your deal. Also, when you're looking at larger money, you're looking at partnership arrangement, and you're going to use that. If you're not strong enough, you're going to use that partnership arrangement to talk to the community bank people or the people that are in a traditional big bank. Those are usually you need a little bit more experience with that, and that's why you're leaning on your partner for those type of ways to fund your deals. But that is a viable way. So many ways to fund your deal. We hope that you got some value add from this, and you are looking at now ways that we can fund your deal. Okay, so we have a question come in, and well, thank you. Actually, it was just a comment that says good class from our Facebook channel. We're hoping that funding is not a limiting factor. You should have a good idea of ways that you can fund that deal. So if you're not looking at wholesaling, you're looking at flipping or buy and hold. We're giving you a bunch of different options, and that should not be a limiting factor moving forward. I want to thank you for coming to this class. I'll see you Wednesday at 11:30. Stay grinding. Stop your